So we've made a lot of progress since the 2008 Great Recession, right?
Yes!
I mean, come on. We fixed the banking system. We set rules in place. We made sure that 2008 could never happen again. But are we quite sure we fixed the problem? Because in light of what's going on with Silicon Valley Bank, Signature Bank of New York, Republic Bank, and now Credit Suisse, it's purely evident that we haven't fixed anything. Matter of fact, the too big to fail is still there. And when you really look at what happened to the banks, my other YouTube video that I did really shows this. So if you're not already subscribed to this channel, let's just take a second to subscribe right now by clicking that subscribe button and hit that little alerts button and make sure you like this if you want to really help. But I did another video explaining exactly what went down with Signature and Silicon Valley and Republic Bank, so you understood it. But basically, it comes down to a liquidity issue. Now, a lot of people are blaming the depositors for running in and doing a run on the banks, and that's what created the problems. And well, partially it is. But the banks, they're responsible as well, because the banks took a lot of your money, the depositors' money, and put it into asset classes, although very safe assets that I talk a lot about, called treasury bonds. Anywhere between 2, 10, and 30-year treasury bonds. They put your money there because it's safe. That's right. Treasury bonds are guaranteed by the full faith and credit of the US government. But what happens when the bank needs liquidity and the assets they have our money in? And what happens when they take the money out of those investments and they lose all of their reserves? Well, you have what we're gonna someday call the 2023 bank crisis, and it's all happening right here and right now at a theater near you. My name's Chris Naugle. This is What Now and What's Next. So what does happen when the bank's liquidity, your deposits, gets eaten up by losses for bad decisions, for making risky investments, for making illiquid investments when an asset price is going down? Well, do they just come to you and just say,
"Hey, Mr. Depositor, can we give you an IOU and we'll pay you back someday"?
No, the depositors lined up out in front of Silicon Valley Bank, Signature Bank, Credit Suisse, and Republic Bank saying, "I want my money.
It's my money and I need it now."
Now, let's switch and transition over to the depositors. Now, I think all of you understand the rules of engagement for when you give up control of your money to somebody else's bank. Because here, let's just do this really quick. This is not a hard thing to understand. You worked for this money. You traded your hours for dollars. This is your money, your business's money. And what do? You take it and you give it to the bank. Here you go, Mr. Bank. Can you hang on to my money? As a matter of fact, Mr. Bank, can you take my money and put it in that little box with my name on it? Yep, that one right there. And throw that back in the vault. Perfect. Thank you so much. Is that what the bank does? No. The bank takes control of your money and does what? A little bit goes to this person for a loan, a little bit over here for a loan, a little bit over here, and well, a wee little bit goes into reserves. And then what do they do with that? Invest it. And that's exactly what happened. The bank makes your money go to work for them. And they make 400 to 1,300% more than you do on the deposits we leave there. But you see, when we give our money to the bank, we also see that little sign right there, FDIC. Depositors' money is guaranteed up to $250,000 per the FDIC. Newsflash, FDIC has $128 billion in deposits as of right now, 2023. Total deposits for all of our money in the US banking system, that's a little over 16 trillion. Hold on a second. 128 billion in insurance fund called FDIC to secure $250,000 deposits of 16 trillion and some change. Calculations. It doesn't add up, but you also need to take some responsibility as the depositor, as do I. Are you gonna leave more than $250,000 in any one bank if that's all they guarantee you is $250,000? Well, I would think not. Come on, we gotta sometimes use logic. And logic would tell us, well, if I put more than $250,000 and this bank goes down, like Signature, like Republic, like Silicon Valley, like WAMU, and so many others. I mean, heck, I think there's been 55 bank failures in, well, last 20 years or so. But no one's keeping track of that. That's not making the news. If you put more than $250,000 and the bank goes under because of stupid decisions the bank makes, you should hold some responsibility, right? Well, that would just make logical sense. But you know what? No. Oh no, the Fed and also FDIC, see, they step in.
And they say, don't you worry, folks. We're gonna make good on that money. We're gonna guarantee an unlimited amount.
Woohoo! All right, good job. Good job. Yep, great. Good job. High five. Pump. Yep, fist. All right, good job, guys. Fed, yelling. Yep, all right, you guys did fantastic. Well, what they did is they actually came up with what's called the Bank Term Funding Program. Now it's got other names out there right now, but Treasury Secretary Janet Yellen said this.
Today, the U.S. banking system is sound, even as it has come under pressure.
She said the banking system is sound, right? That's what she said. Hold on, let me just check. I could have this wrong.
Today, the U.S. banking system is sound.
So what do you call sound? Well, how about a global backstop that's propped up with a printing press? Yeah, that's about all they've got, right? They've got a printing press that prints these things, these Fed notes, yep, these fiat dollars. Yeah, they can print as many of these as they want when they have the full faith of all of us and the rest of the world in the US dollar. But what happens when the rest of the world says, you know what, those guys over there in the US, that Fed and that Yellen and the US government, they're printing all this money in that printing press, unlimited backstops for bank failures and risky bank moves, and they tell everybody that they're going to guarantee them up to $250,000 with the FDIC, but then when the bank goes under, well, then they just bail them all out. And who did they bail out? Well, if you really look at Silicon Valley Bank, those were venture capital funds, okay? Those were tech companies. Those were millionaires and billionaires because if I'm not mistaken, 97% of all the deposits in that bank were over $250,000. Oh, you know who else? Shh, don't tell anybody. Yeah, Newsom. Yeah, that Gavin Newsom joker over there in California. Yeah, he had some money at Signature Valley Bank too. You don't think that had anything to do with it. But anyway, no one's keeping track. Look over here, come on, over here. All right, guys, keep going, over here. There we go. That's all that's going on. It's like the carrots over here, but you should be looking over there. Nothing to see behind the curtain, folks, nothing at all. The global backstop is being guaranteed and backed up by a printing press of these things, which really are not worth much of anything anymore because they just keep printing more and more money. They blossomed up the Fed's balance sheet quite a bit. So prior to this whole banking thing, the Fed's balance sheet had about $8.6 trillion worth of those IOUs from the government and everything else. So if we just look at, March 8th to March 15th, the Fed has expanded its balance sheet by a mere $300 billion. Man, that's a hard day's work. March 8th, let's see, so that's 8, 9, 10, 11, 12, 13, 14, 15, in just over a week. And they did that by lending, about $143 billion to that Silicon Valley Bank out there. Yep, and then a little bit to that Signature Bank of New York or whatever they called that thingamajigger. Yeah, and other undisclosed banks. $143 billion, no big deal. I mean, as they print more and more money, this is kind of what our money starts to look like. They just keep chipping away the things. Oh, actually, you know where else they did that? You should study Rome. Because in Rome, they did something very similar. They would take the coins and they would clip the corners because they needed to make more money. And how they did it is instead of printing more, because they really couldn't with gold coins, they would just take all the little corners off the coin, which would make the coin slightly smaller. You should check this out. It's in the history books. And then they thought nobody would notice. Oh, here you go. Here's your money. And then they would take all those little corners and they would melt them down and they would just create more money. But every time they did that, the money had less value because it was smaller. Do you really think that's any different than what's happening today? It's the exact same thing. Oh, but hold on. I got something else. Because there is some progress. All these other good banks, they're coming together and they're pooling all their money together and they're saving these failing regional banks. The banks that are too big to fail, oh, no, they're not. They're not having any issues whatsoever. Oh, yeah, they all come together and they just pool all their money and they just say, hey, here you go. Here's $30 billion as a backstop. We're just gonna help you out. Where'd that money come from? Did you ever think about that? You know, when they were propping that up, and I believe that was to save First Republic Bank, if I'm not mistaken, $30 billion. Let's just do the math on that. So I would have to believe that that $30 billion is coming from, well, I don't know, the CEOs of the bank. Maybe they're going into their private money and saying, hey, this is a solid investment, let's do this. So I mean, clearly it would only make sense that the CEO of JP Morgan & Chase, Jamie Dimon, it must have came out of his own pocket, right? Because right here, if I look at how much this guy's got, I mean, he's worth about $1.8 billion. That's his net worth. And if I look right over here, his salary last year was $34.5 million. So I mean, of course it came out of his pocket, right? Actually, it didn't come out of his pocket, it came out of your pocket. That's right, all JP Morgan Chase did was take some money and shift it from the balance sheet over to First Republic. That's all. It was your money. It was your deposits. And they did this on an unsecured and uninsured basis. Risky drivers, you might say? How JP Morgan did this is they didn't buy FRC stock. We're gonna come over to the FRC stock, the Silicon Valley Bank stock, and also Signature Bank of New York stock. We're gonna talk about the stockholders and the bondholders of those banks, because those are the ones that really suffer. And who are they? You've been told to buy the bank stocks. You've been told, oh, they pay a dividend, they're good. Oh, they're just great, aren't they? But you see, the big boys aren't buying the stock. Not even in a takeover like this, not even when they're saving the bank. All they're doing is making a loan. Banks make money by making loans. Whose money are they lending? Your money. Why? Well, because they know the Fed will stop in if they screw up, so let's take riskier bets. Let's not use our own money. Good job, Jamie. Good job, Jamie. But let's talk a little bit about how much money do these CEOs of these failing banks or any of these banks make? This blew my mind. Silicon Valley Bank. The CEO's name was Greg Becker, but he pulled down a measly $9.9 million last year. That was his salary. Oh, and then Signature Bank of New York. Yeah, Joseph DiPaolo. He pocketed a cool $8.6 million. No big deal. It's a sound financial system, right? Nobody's taking advantage of anyone here. Everybody's being made whole. Over here, folks. Psst. Oh, but it's not gonna come from the taxpayers. So where's it gonna come out of? How about higher bank fees? Yeah, because they're gonna charge the banks. They're gonna charge the banks higher insurance premiums because they gotta bulk this up. They gotta fix this problem. And who's gonna pay for that? It's gonna be you. That's right. It's not the taxpayer, but it's the same person. It's you, the depositor, that's gonna bear the weight of all of this mess. That's if the mess actually doesn't get worse, which I think the mess is gonna get a lot worse. Your money isn't sitting in the vault. Your money's out working for the bank. And the bank, I think I already said this, but I'm gonna say it again because it should really make you mad. The bank is making 400 to 1,300% more than you are on the deposits that you leave there. Or I like to say the deposits that you gave up control of. So real quick, let's just talk for 2 seconds about one thing you should really be taking from everything that you're seeing in the news, everything I'm teaching you, everything you're hearing Ray Dalio talk about, and so many others. It comes down to this. Now, more than ever, is the time to take back control of your money. Now, more than ever, is the time for you to become your own bank, to mimic what the banks do, but to do it in a different place. Change just one thing, and that is where your money goes first. And then when you change where your money goes first, then add one step. Can you all do that? Can you change just one thing? And that's where your savings goes first. And once you change where your savings goes first, can you add one step to how you use your money? If any of you said yes, good. So at the end of this video, I'm gonna put up another one that's gonna teach you how you can be your own bank, how you can do exactly what the banks do, not the risky, stupid stuff, but how you can make a spread on your money and how you can make your money work harder for you instead of working harder for the bank. Because the bank, well, they don't seem to be doing such a good job for you on your deposits. They're doing a good job for themselves. They're taking high risks because they know now that the Fed will just bail them out. And I think that's one of the scariest things about this whole thing. Folks, the future is gonna be pretty interesting. And I can't tell you what it's gonna look like, but I can tell you one thing you better start doing. You better start taking back control of your money. Thanks for joining me for this. My name's Chris Naugle, and this is What Now? What's Next? And what's next is you watching this video right here. how you can become your own bank. This is vital that you learn this, so check it out. And also give this video a like, and also share it and subscribe right now. We'll see you on the next one.